Hello ladies and gentlemen, welcome to my channel. My name is George Kingori. I'm your online finance guy who speaks about all things finance. How you can be able to grow, how you can be able to invest, and how you can be able to grow in your finances. And today I'm going to speak about Kenyan government bonds versus money market funds. I receive a lot of questions as regards to money market funds and government bonds and how these two are different from each other. And I'm going to tackle it from several of the differences that you can be able to see. The first difference is in capital gains. Capital gains, money market funds do not have capital gains. That means you cannot sell your securities at a profit, but you earn monthly interest that is compounded every single month. This is compared to government bonds, where you can be able to sell them at a secondary market through a broker and be able to get some benefit beyond what you have actually paid for. So you can be able to get some capital gain from the sale of government bonds, but you cannot do the same with money market funds, since you sell at a ratio of 1:1 from the same provider of the money market fund security. Then the other thing is, of course, the secondary market and reselling. You cannot sell a money market fund instrument to an open market or a secondary market and sell through your broker to other people. However, for government bonds, you can be able to resell your security in government bonds to other third parties through your stock broker. And you can be able to do this, but you cannot be able to resell your asset to other people in a money market fund, but you have to sell to liquidate. So in the first instance, you sell to liquidate, in the other one you sell. The other difference is, of course, in the length of time. Government bonds have been specified on how long these government bonds may take to mature from the government. They are specified in the number of years and how long, and the terms are specified. The rate of interest is also specified in the length of time and all these things. However, a money market fund can be liquidated at any time on a notice of at least maybe a week or 3 days or a certain number of time, but you liquidate it as soon as you feel you need the money, and there are no restrictions to it. However, with government bonds, for you to liquidate it through the government, you have to wait for it to mature, or you can resell it through a secondary market, and the assumption is that you would find somebody who is willing to buy off this security. So the length of time is also another difference. Of course, the other thing is in the interest. In a money market fund, the rate of interest may fluctuate. Actually, there is no contract document that specifies that you will receive this assured rate of return every single month or every single year. The rate of return actually fluctuates, and because it fluctuates, you cannot specify how much you'll actually get from money market fund. It might be high, it might be low. However, with a government bond, it is specified that you're going to receive this rate, and you're going to be receiving for this time, maybe every month or every 6 months or this and this time. So it is specified when you will receive the interest and how much. So for certainty, if you want certainty, go with government bonds. If you want for it to have flexibility to go up as high as you want, then go with a money market fund. Of course, the other difference is the security of the investment. In a government bonds, the person who is issuing this instrument is the government, and the other one is issued by a private entity, sometimes an insurance company or an investment firm. And security in these investments in government bonds are highly, they cannot just fall by the wayside. The government will always pay you, because the government, unlike an ordinary individual, may not go into financial distress to a point where it cannot meet its obligations. The most it can be able to do is reschedule, but it will never go bankrupt. This is because it is always collecting taxes, it is always levying charges, and worst case scenario, it can always print more money. Of course, that is the worst of route, but government will never run out of money. However, private entities and companies may fall because of poor leadership, may not be able to liquidate assets well enough to be able to repay you when you need money may have certain financial distress, and so there is always an underlying risk as regards to investments in money market funds. And that is why the Capital Markets Authority in Kenya and in other countries requires that they invest a certain portion of that money in government bonds, so that the people who have invested through this company can at least get a portion of the money that they have. And there is also cash reserve requirements that have been specified and all these things. And also the money is held in a custodian account that is not owned or directly in the name of this individual or this company. And so there's some level of security. In terms of security of investment, government bonds are always foolproof. So that is in the security of your investment. Of course, the other thing is in the amount of money needed. Government bonds require a specific amount of money that is needed and incremental amounts of a specific amount. In Kenya, government bonds can start from 50,000 with incremental figures of 50,000, 50,000, 50,000. That means that you can only invest 50,000 minimum, or 100,000, or 150,000, or 200,000. And that is for ordinary government bonds. For infrastructure bonds, it might go as high as a minimum investment of 100,000 going up. And that makes it a bit strict in terms of how much you can actually invest. However, a money market fund may have much more flexible terms in terms of how much money do you need to put down for your initial investment. Some start with 2,000, some start with 1,000, some start with 500, with incremental figures of whatever amount you are willing to put down. You can even have a rough figure like 1,111 as an investment, because they're a bit more flexible. So flexibility in the amount that is required. Government bonds, of course, do a lot poor because you need a lot of money and incremental figures of 50,000 going up. But money market funds are a bit more flexible. Of course, the other thing is in the compounding effect. Money market funds allow you to be able to compound your interest by taking your interest and reinvesting it subsequent to receiving this investment. So if you do not withdraw your interest, it remains in the fund that again compounds, and you can be able to enjoy this compounding effect by investing in money market fund. And if you invest for long enough, and if you reinvest the interest for a longer period of time, you can actually get more than proportionate growth in your portfolio in a money market fund. However, this is not the case for a government bond, because a government bond will pay you interest at the specified period of time direct to your bank account. And for you to be able to enjoy the compounding effect, you have to go an extra mile and take that money and invest in an additional bond. So again, you have to actively do that. However, in a money market fund, it is almost automatic as long as you do not withdraw that money, that interest, after you have received it. So the compounding effect in government bonds require active involvement. However, this is not the case for a money market fund. So if you want much more passive management of your investment, go with a money market fund. And if you want to enjoy much readily available compounding effect, then go for a money market fund. Of course, the other thing is in the interest. And in this case, the interest, I want to talk about the treatment of interest income as regards to taxes. So how do taxes affect you in a money market fund versus a government bond? In a money market fund, you are always charged, at least as of now in Kenya, 15% of your interest. So if you earn 1,000, then 150 is taken by the government as interest on the or as tax on the interest that you have. And again, this is the final tax, so you will not be taxed again. So that is all the time automatic. If it is every single month, it is 15% of what you have earned that single month deducted every other time. However, with government bonds, some have different terms. The ordinary ones that I have nothing special, again, charge you 15% of the interest that you are earning. However, sometimes to attract more investors, they might specify a lower rate, say 10% or 5%, or in case of an infrastructure government bond that is an infrastructure bond that may be longer, they may specify no interest at the end of the day. So again, it fluctuates based on the policy and based on how the government wants to encourage or discourage investment in these government bonds. So that is the case with taxes as regards to these two. Then the other thing is a difference in the opening of this account. For you to invest in government bonds or treasury bills, you need to open an account, and as an account with a CBK, a CDS account, a Central Depository Security account with the central bank. And you need to physically go to the central bank and open it and deposit it. Then you link it up with a broker who can be able to do any subsequent trading on your behalf. However, for a money market fund, you do not need to go to the government, but to the investing institution that manages this money market fund, and directly go to them and be able to apply and get your money market fund running. So again, a little bit more complex when it comes to government bonds. However, a lot easier as regards to money market fund. However, it is not too stringent and is almost as easy as the other. So those are some of the differences as regards to government bonds. So how do you treat? When do you invest in money market funds? When do you invest in government bonds? And what are you looking to be able to enjoy? If you're looking for higher interest and at a specified, a certain fixed interest, then go for a money market funds. If you are able to get an attractive government bond that can be able to offer you a fixed interest rate for a fixed period of time, then you can be able to enjoy some level of certainty. If you're looking for security in your investment, that nothing will happen to your investment, then go with a government bond also. However, if you want to take a little bit more risk at the advantage of you can earn a little bit more interest, then go with a money market fund. Again, additionally, if you want to liquidate your investment at a moment's notice and you want to have the flexibility of the amount of money that you're going to increase every single month, and if you want to treat it a little bit more passively in terms of compounding your additional interest, then go with a money market fund. I hope that you are learning. I hope that you are growing and you are gleaning and you're on your way to even greater financial returns. Thank you and enjoy your